I'd pay my claims people the same as I paid my underwriters. And that's a bit of a, it's a shocking statement, but our underwriters in many cases, produce great business. So if we want great results from our claims people, we probably should incent them to also to work the same way as our underwriters do, right? Because a bad claims process could cost you millions of dollars, right? And it could burn reinsurance relationships. It can burn customer relationships. How you handle the claim, whether you're confrontational or not, will change people's perspective on the company, your reputation, right? It really is a key. I mean, our CEO runs around and tells everybody, and I'm happy he does this, how critical our claims organization is to our success as an insurance company, right? It is something we hold up and we're really proud of. A lot of insurance companies don't do that.
Welcome to Pioneers, the show where we explore the intersection between humanity and AI. I'm your host, Ankur Patel. Over the last 10 years, I've built 3 AI startups, written 2 books about the subject, and I run a weekly AI newsletter. I also regularly teach and speak about the topic at conferences. This technology has grown faster than I think any of us could have imagined, and it's making us ask really important questions, such as how ethical is AI? What will this technology look like in a few years, let alone a few months? And most importantly, does it have the power to truly change the world? And what does it mean for you? On this show, I'll be interviewing the founders, operators, and pioneers that are introducing AI into their companies and industries. We'll be asking them the really heavy-hitting questions that make them dig deep into the core of what we do. And without further ado, let's dive into today's episode. Welcome back to the show. I'm your host, Ankur Patel, and today my guest is David Mocklow, Head of Strategy and Transformation at MSIG. David, welcome to the show.
Thank you for having me. I'm looking forward to talking with you.
David, for the sake of our audience, could you just give us a little bit of a backdrop as to what you do at MSIG, as well as how you got to the particular role that you're in today?
I think that answer is a little bit of a long journey because I used to wear a lot of hats at Mitsui when we first reinvigorated the business here. Joined the group 4 years ago. Mitsui had a small operation in the States, largely here to service our big multinational clients, a lot of Japanese clients in the States. And the executive team in Japan made a decision to really energize the US operation. And back then, there weren't many of us that were new to the company that could, if you will, inject some new ideas into the company. And I was lucky enough to be part of the early leadership team. And as part of that, I was putting on a lot of hats. There were days where I was thinking about our operating model. There were days I was thinking about business development. There were days I was working with consultants on technology and other elements of our business. And then just sitting there imagining what we could do from a capabilities perspective. But I also got tasked with starting to help grow our original delegated business channel. And we were fortunate enough to partner with a big aggregator and build a big delegated business around that. And I got lucky enough to be part of that journey to build that out. But now, 3 years later, we're on a bit of a rocket ship, right? We've been growing successfully. Our CEO has brought in some extraordinarily talented people. But at the same time that we're growing rapidly and adding lots of capabilities, we still have to bring up to the modern age our infrastructure. So a lot of my attention now is spent on helping to think through how we could use some tools, not just to get us to the current state of play, but to try and leap forward in time. I sort of often describe it as a bit like what India went through with telephones, right? They essentially said, we're not going to connect the country with landlines. We're going to go and put everybody connected with cell phones. We're trying to do something here similar at Mitsui Sumitomo. We're trying to take a leap forward with our thinking. But one of the areas that I'm keenly focused on is on the claims side of our infrastructure. And it's an area I find fascinating and have had a lot of history with over the years, both in various parts of my career, because I've not always been just, focused on the insurance industry. I've had a little bit of as the Australians say, I've had a little bit of a journey and a wandering through the insurance industry over the last 30 years.
Amazing, David. Well, I appreciate that backdrop because it feels like you're trying to change the industry in a more dramatic way. And you don't view this as just keeping up with the Jones, but you see this as part of the competitive advantage that you can establish, for your organization in the long run. We segment this episode into two parts. I'd love to kind of dive into the macro environment, the backdrop that insurance is in today, because I think that is very motivating and clarifying for our audience that is trying to understand what are the pains, the problems, the challenges that insurance as a whole faces. And then the second part of the episode, we could really focus on technology, particularly maybe in claims as a focal point. So what is this technology, perhaps powered by AI? What does that mean for claims going forward in the future?
Sounds good.
Okay, perfect. Well, maybe the first question here I have here is maybe if you could just describe a little bit more about the bigger macro backdrop for insurance claims and the biggest forces that are shaping it today.
Yeah, and I'll start this sort of answer, if you will, with a bit of a story, because I think some of the things we'll talk about are not just problems that have arisen in the last couple of years. They've been systemic issues that the industry's always faced with. And during my career, I was lucky enough to spend a little bit of time doing things like investment banking, raising capital for insurance companies, and capital markets activity. So I was always involved in stuff where I was able to see a lot of rapid change in the industry. So when insurance-linked securities first came along, everybody in the marketplace was like, well, what do you mean you can take your win risk and push it into a limited partner or a fixed income fund? But now nobody bats an eye when they say they're going to do an ILS transaction. But, when that first came along, everybody looked at you like you had 10 heads. And then when I got into more traditional investment banking, I got to be lucky enough to see inside of a lot of companies. And there was one in particular transaction where I sort of got a PhD in the claims space, although I don't think I realized at the time. We're working on a capital raise for a company that specialized in buying blocks of insurance claims from insurance companies. And I got the chance to sit down with all the experts inside that company, and they were telling me stories about the sellers of the transactions and the way they approached dealing with claims. And this is a transaction that was 20 years ago. And the stories they told me were shocking about the failures of the insurance company to do things with claims that you would think would be normal course and good activity. And then a few years later, I was lucky enough to get involved in a capital raise, a big capital raise, $1 billion capital raise. And we had a big 60-page presentation, and we went to AM Best to present how great the management team was and how wonderful the asset management strategy was and what the track record of underwriting was. And on the last page of the deck to AM Best, on a slide titled Other Matters, the third bullet from the top, it said, our claims will be outsourced to either Sedgwick or York. And at the time, they were two separate companies. So there were 59 pages spent on how wonderful the company was and how great it would be accumulating premium. And they gave one line to what they would do with 70 cents out of every dollar. And AM Best didn't sit there and quiz them on their claims capabilities, which was shocking to me. And those two stories really stuck with me. And when I got into the industry again, when I came back to the industry and I worked at Mitsui and I started seeing a lot of claims activity, because we deal with a lot of TPAs. And so I've been around the space a lot for a long time. And it's really, in a way, it's a bit shocking to me. We still see the same practices that we saw 20 years ago. We still see people dealing in manual environments. We still see people dealing with things in a way that sort of most of the industry has sort of looked at and said, that's not a good process, or wait a minute, maybe we need a different type of person to deal with this particular situation. So our problems are not new, right? They've been around for a long time. And it's unfortunate for us because while we've got these problems that have been around for a long time, the plaintiffs' bar is in a nuclear arms race and they're running away from us, right? We see the stories every day about the tools they're using. So it's going to be tough for us to overcome that. But more specifically to your question, right? What do we have? We have a shortage of people in the claims space. There's no doubt about it. Everyone we talk to says there are not enough claims adjusters, number one. Number two, we don't really want to pay the people that we do attract a wage that we think is commensurate with the skills they need in today's environment. Number three, the average age of the employees in the industry is older than other segments of the insurance industry. And there's a lot of knowledge in people's heads.
Yeah.
And it takes a long time to take that knowledge and distill it to their young people coming into the industry. And so those problems are not going away. Those problems are here, and we have to deal with them.
I think it's a very clear articulation, David, on that, which is, on one hand, you have better technology available to plaintiffs being able to bring up claims, right? So there's like maybe some deluge of volume, and it only gets exacerbated because you have technology like AI that allows basically those claims volumes to come in more easily with less effort. And when you make something easier to do, you just see a whole lot more of it, right? The demand for it increases because it's just easier to put forth. And then I think on the other side, you have maybe fewer claims professionals that are maybe aging out to some extent. They have such immense institutional knowledge in their heads, and the ones that are coming in to fill the void are less skilled, less equipped. And the challenge that I think that you're speaking to is a lot of that institutional knowledge is in people's heads. There are claims processing guidelines. There might be some standard operating procedures, but there's still a lot more that's maybe stuck in people's heads and hasn't been maybe documented and made available. And even if it were available, it takes a while for that gap between the veterans that have all this knowledge and some of the newcomers to, it takes a while for them to acquire it. So it feels like that is a common theme that we see, which is not enough people that are skilled to go and handle this. Can technology fill the void, right? And that's something that I think we've heard.
I think there's actually another thing that's actually compounds that problem. Technology, the changing sort of environment for how we underwrite and who's underwriting, tons more MGAs, the E&S market is going like crazy. AI will help us develop new products at speeds we've never developed before. The E&S market, which used to be a market where you kind of went as a market of last resort, is no longer the market of last resort. It is the market where innovation is taking place. We have products that are being developed with levels of complexity around the claim that even highly skilled claims adjusters are going to take some time to adopt to. Can't imagine putting a 28-year-old into a claims seat and giving them the following case. We are insuring the personal lines liability of a Uber driver, and the Uber driver also has a commercial lines policy. They've gotten into a crash, but the passenger's not in the car yet, but they've accepted the job. Is that a personal lines claim going into one policy? Is it a commercial lines claim going into another policy?
Yeah.
If I'm a 28-year-old adjuster, the first thing I do is I call an attorney. Right. And up go the costs of the claim, and the claim might be a $500 fender bender, and you spent $1,000 on legal fees, right? Those I think about where we are going from a product perspective, and I think people underestimate that the problems we have are getting worse. They're not getting better. And technology is only going to help us in those modern situations. We don't know how much technology will help to stem that problem.
Yeah, I think there's a lot of innovation on the underwriting side, which is great because you have a lot of gaps in coverage that are filled by newer insurance products that are coming online, but that makes the claims part harder. I heard you say, maybe would love to tease this a bit more, is what is behind the trend of outsourcing the claims functions? What's the temperature in the room of maybe pushing that outside of the core business that the carrier does and relying on the third parties to do so?
There's a variety of factors, as you might imagine, right? Number one, it's a not uncommon thing for carriers when they retreat from a market to want to cut costs. So they generally think about where they can outsource. If they launch a new product, they typically look around their claims department and say, do we have people skilled in that particular claim? If we don't, let's bring in a TPA that might have a skill set in that particular claim. Or they might be working with an MGA who's got a skill in underwriting, but also says, I know the right TPA to work for you. Why don't you let me use my TPA instead of you picking the TPA that you want to work with you? So there's a ton of reasons why that's going on. I also think that momentum will pick up because I think some of the TPAs, I don't know that it's taken hold yet, but some of the TPAs will, I think, be faster adopters of new technology than carriers will be. And those TPAs, if they do it right, will be able to show their customers better results. There'll be better transparency on the work they've done, the results they've done. And that might lead to an outsourcing methodology, an increasing outsourcing methodology of the carrier market. And by the way, listen, the MGA market is the fastest growing part of the world. The MGAs are used to going to TPAs to service their work.
Yep. So you have specialized players that then get very good, maybe even are faster adopters of newer technology. And so maybe this accelerates that trend to TPAs.
We hope.
Because the alternative is that carriers view emerging technology that's coming online as a way to bring some of this in-house, to use that as a competitive advantage. So it's more tightly connected to the underwriting side of the house. But I think that requires very intentional and strategic frame around how to do claims extraordinarily well, because there are third parties that might be better suited. So it's kind of it's a very difficult choice, I imagine, for a lot of carriers going through this.
It is. And some carriers, I think, are sort of diving deep into that model, and others are going to move a little slower.
Well, let's go maybe back to the significant risks I think you alluded to posed by plaintiff technology advancements like Litify and Even Up. Can you speak a little bit more about that?
Yeah, it's interesting, right? Because sometimes I feel like I'm a little bit out there and yelling into the wind, and a lot of people don't pay attention to some of the things that are going on, but they stare you in the face, right? We in the insurance industry, right? We either have a frequency exposure, we have lots and lots of claims, or we have a severity exposure. We take big claim. We have big claims because we write big limits on big complex risks, and so we can get, if you will, beaten's the wrong term, I think, but we can have a lot higher claim activity, both from a frequency perspective and a severity perspective. The worst scenario is if you have an increase in frequency of severity. And what we see going on with both litigation financing and with the tools that the plaintiffs bar are using to, in effect, democratize their toolkit, right? Any plaintiff can go on to Litify and get some information about a claim. Any plaintiff can go on to Even Up. And all of a sudden, all that information is all over, if you will, the industry. And they give them data and tools to immediately hit a carrier with a barrage of items, right? Whether it's demands or nickel and dime stuff, it doesn't really matter. But now you supercharge that with litigation financing, where they're dropping money to these firms to try and go off after more frequency, more severity, more frequency of severity. That's potentially a recipe for disaster. And it would be bad. But what makes it worse for us as an industry is we're largely in the business of making risk decisions, right? There's a limit to how much premium we can tell the client and their broker that we want for our capacity. Because a broker could say, well, you're charging too much. I'm going to go to your competitor down the street and maybe get the same terms and conditions for a lower price. So there's a limit to how much we can push on pricing. All else being equal, plenty of exceptions to that rule.
Yeah.
So what we have to be really good at doing is selecting good risks, right? Because we can't really affect price. So we got to be good at really selecting risks, because if we select bad risks and we have a claim, that's a bad outcome for us as a book of business. But if our mistakes are magnified by problems with either our process or because we end up in court with a gigantic demand, we suddenly have significantly bigger downside for the mistakes that we made. So that's the problem. I think people spend too much time sort of thinking, oh, it's not a big deal. But the price of making mistakes is being magnified for a lot of companies, whether it's because they're seeing more claims or because the tail's getting bigger. And one of the things that doesn't help us in the industry is we tend to look backwards to figure out what rates are and what prices are.
Yep.
And if we look back over 10 years, this impact is somewhat muted. If you look back 2 years, this impact is extraordinarily strong for some companies. But you don't typically change your rates based upon the last 2 years, right? So you've got to be extra careful at risk selection. So I think, I don't know that a lot of people sit there and process it that way. They tend to think, oh, well, The actuaries haven't seen it yet, so it must not be an issue. And, we can keep going on with rates, et cetera, et cetera. I'm a little bit out there in that theory because I sort of worked for a little while in the financial markets where price discovery on both sides was a little quicker, right? You know how much you bought something for, and the next day you could go on a Bloomberg and see what the price is and react. We don't get to see what the price is for some period of time, do we?
Yeah, no, I think the analogy to financial markets is great. I mean, you're basically, as a carrier, taking on a book of risks, right? Risks that may pan out or might not pan out, right? And it kind of feels like, in some ways, like you're selling CDS. That if there's a credit default swap, right? So basically you get premium for selling the CDS, but if there's a credit event, all of a sudden the payout could be massive, right? And the CDS that you sell might look like a great business in the short run because you're collecting premium. But then if there is a tail event, if it's a correlated tail event, hits the broader market, all of a sudden you have this massive payout that's very concentrated in some due time. And so I think it's very important to understand the risk that you're taking on. And if you could connect some of the claims discovery, like what's happening in the claims side, to allow you to more real time reassess the risk that you're underwriting, that is such a strong informational advantage for the underwriting team relative to other carriers, right? And I think that frame is a very strong frame. It borrows heavily from financial markets.
Yep.
And sometimes I don't see that actually among insurance carriers quite as acutely as you're mentioning.
I'm a big believer in signals, right? I'm always looking for some way to find signals. The signals might not drive me to take an action, but it might inform me to say, maybe I want to limit the amount of exposure I have to something that has similar signals. So for example, if it takes, and I think this is an industry issue, so we're talking about the macro environment, if it takes a year or two to finally get enough information through the claims process that maybe this claim could become a really big, ugly event that hits New York's, Brooklyn Superior Court. And if it takes 2 years to get to the underwriter's written 2 more years of business, some of which may have exactly the same exposure. What can we find within minutes, days, at worst weeks, when we get the first notice of loss to go, there's a signal in there. Let me see if that sort of has a correlation to the business I'm underwriting, and let me alert my underwriters to that signal.
Yeah.
I think that's where we need to go. I don't know that we're ready for that, but that's the sort of stuff that's on my mind, right? How do I give my underwriters more insight into what's bubbling over on the claim side of the business?
Yeah, absolutely agree. Well, could you explain also the concepts of real and social inflation and how they're affecting claims costs and strategies?
Yeah, it's funny, right? Again, this is very line specific, right? So inflation hits auto insurance very differently than it hits, say, the general liability insurance, right? In auto, you have replacement of real parts. Real parts get more expensive over time, and there's not necessarily what I call price inflation. There's component inflation, right? A car that has a fender might cost $1,000 today, and in 2 years' time might cost $1,300. A car with a little bit of the same car that's now got a fender with lots of LiDAR and electronics in it might cost $2,000 today. Next year it might cost $4,000. So because the components are newer, that they haven't experienced Moore's law, right? They haven't come down in price. They're just getting continually upgraded. So that component hits the business extraordinarily fast in the auto sector. In the other lines where you're not really looking at true assets, but you're looking at negligence, right? Negligence is effectively an asset, right? You have to pay for it. It's an asset of somebody who's been injured. And the inflation there isn't as easy to spot because it is sometimes a function of territory. I'm more likely to see inflation in a liability claim in New York or in Illinois than I would say in a state like, I don't know, Oklahoma, because again, the tail is rapidly increasing, and it's that tail that changes the inflation calculus, right? I'm only using a few data points to come up with a trend that's really, really ugly from an inflation perspective. So I think you have to be careful that you parse what's real asset-based from social inflation. Now, we in our industry don't like uncertainty. We hate uncertainty, right? And so it's really unsure as to what the effect of social inflation is going to have on our business. I've read a few papers by sociologists who say, it's all these younger people who are going into court and want to stick it to the man, right? Look at the United Healthcare CEO. It's shocking how many young people think that that person deserved their getting murdered. Well, what would you imagine would happen if United Healthcare was in court, right? It's going to be a similar population of people potentially in the court, or even one or two people. So we've got that element as well. And that, again, is also, I think, sort of location dependent. And it's hard to know. You can't be certain about what that impact is going to be. So I think the uncertainty about what the social inflation actually is the hardest part. And by the way, what does that speak to? It just speaks to the need for great claims management, right?
Yeah.
Just speaks to it.
Well, close this macro theme out. What are the dangers for the industry if it fails to respond to some of these trends, especially in a possible recession or softening market?
I would think there's three things, right? One, there's the general economic condition of the insurance company. A lot of them are publicly traded, right? So they've got to make their analysts happy. And you might suspect that some of them might be willing to cut expenses. They might be willing to rethink their business models. And so you've got, at a moment in time, you might have somebody who is under an impetus to, weaken their staffing model. At the same time, they might be sort of tinkering with their reserve position because they want to be able to continue to meet the earnings targets. And all of that is a bit of a recipe for a challenge in how you deal with the reality of increasing litigious claim environment. So I think there's the natural sort of machinations of a company during a softening period. Then you really have what happens to claims in a recession softening period. There's plenty of people out there that say the claims frequency go up. And I'm not going to dispute that. I think there's some truth to that. It's not true for every case, but certainly fraud goes up in many lines of business. Workers' comp is a great example, right? Fraud goes up. People's behavior changes in a softening market. And then the thing that maybe is perhaps the most important to this conversation, they stop investing in their businesses, right? If you're the CEO and you've got a discretionary amount of money to put on something that might advance your business model, you might sit there and go, maybe I'm going to wait a year before I spend that money. And that to me is sort of, I think that's a little bit, I think that's not a good way to run your company, right? I think it's at that time that you really should be thinking, man, I want to have my company finely tuned so that when the market does turn, I'm in a great position to really financially benefit from a better market condition. I don't know. I'm sort of like the Warren Buffett, if you will, right? I sit there and I don't think a down market's a time you retrench. It's actually when you prepare yourself for the inevitable better moment that's going to come down the road.
I think that's right. I think those are really wise words, right? Which is like you have the moment in time when things are a little bit softer to invest very methodically and intentionally for when things get better. And then you're able to be very competitive in a way that maybe your peers aren't because you're pulling back, they're clawing back.
I agree.
So I think that's huge. Okay, so maybe if we take a step back here, let's talk a little bit more about why claims functions have been historically under prioritized compared to underwriting or sales.
I think there's a lot of factors there, and I'm a big student of the history of stuff, right? I always look back because we're a people business. People have been trained to think about the industry, often by people who have come from a time where they're a little bit older and they've been through a system, right? So we tend to repeat the sort of same things that we've done for many, many years. So, Lloyd's is a great example, right? Lloyd's is a syndicated market. That means all the underwriters essentially sign on to a risk and they all elbow each other and the brokers to make sure they're in a superior position. They get the share they want. But then what they do is when there's a claim, right, there's a syndicated response to the claim. They hire a DCA, a delegated claims authority, and that claims person has responsibility for the market's response to the claim. Let's say we have 10 syndicates on the claim. and there's a TPA representing all 10. Which one of the 10 carriers is really watching the store to make sure that that claims adjuster is minding the store, right? And I'm old enough to have been around Lloyd's. I remember the very first time I went to Lloyd's. I won't say the year. I walked into the ground floor of Lloyd's and there was not a single computer on the floor, not one. Yeah. And then I went upstairs to the 7th floor to an office. I happened to be working for a big insurance company, and we had no computers in the floor. And it shocked me, right? It felt like being in the 50s. And I tell that story because a lot of people get trained or have spent time working in the UK and in the Lloyd's market, or those sorts of people have infused the practices over here, right? So when you are a DCA for Lloyd's, you might also become a TPA for, a carrier, right? So you do the same thing. But because those folks have never been pushed, right? They there's nobody minding the store telling the TPA, why aren't you doing a better job for me? Or why aren't you giving me some better data? Or how can you not tell me how your performance is on my book of business? I think that became sort of an element, not the biggest element, an element. But now you migrate over to the US, and the insurance industry has typically been all about revenue, right?
Yeah.
Go out and write premium. And all the incentive models had been around writing premium. So the MGA community for a long period of time, MGA was a 4-letter word, right? Because they typically produced business that you can never guarantee would always be profitable because they didn't really pay the attention they do now on claims. And so the carriers were sitting there saying, oh, well, it doesn't really matter if we have a claim this year because you're going to make it up for me next year, either to the broker by giving more business or to the MGA or client because they're going to repay you the premium for the loss you paid, right? It was effectively a payback. You were going to pay me back over time because we're members of the same country club. And those two factors really built an industry filled with people who were good at underwriting and good at finding revenue and good at being brokers, but where the claims function was never an important driver of any of those decisions. And to a certain extent, I think an indicator of that has been the success of the legacy market. Look at how many legacy companies have spun up and acquired books of business from insurance companies because the insurance companies have sat there and said, we didn't do a good enough job on the claims. This is now a weight on our balance sheet. We need to get rid of it.
Yeah. And I think the challenge today is a lot of young people don't want to go into claims, right? They're not producers. It feels a little bit more administrative.
Right.
And then when they get to work, often, right, anecdotally at least, they're maybe astounded by the technology that's available to them and how seemingly manual a lot of the work is. It feels like shuffling paper from the office, as an example, right? And I think that's a huge barrier because, as you mentioned earlier, there is an aging workforce. We do need young people to enter this space and get really good and fill the void that's being left by a lot of really talented people that will soon retire or are retiring. So how can the industry overcome some of these challenges, both in attracting talent and then filling some of the gap left by the aging workforce here?
I know what I would do if I were running a claims organization. I'd pay my claims people the same as I paid my underwriters. And that's a bit of a, it's a shocking statement, but our underwriters in many cases, produce great business. Mm-hmm. So if we want great results from our claims people, we probably should incent them to also to work the same way as our underwriters do, right? Because a bad claims process could cost you millions of dollars, right? And it could burn reinsurance relationships. It can burn customer relationships. How you handle the claim, whether you're confrontational or not, will change for people's perspective on the company, your reputation, right? Mm-hmm. It really is a key. I mean, our CEO runs around and tells everybody, and I'm happy he does this, how critical our claims organization is to our success as an insurance company, right? It is something we hold up and we're really proud of. A lot of insurance companies don't do that. They are essentially sitting there saying, it's a sunk cost. But to attract people, I'd pay them. I'd raise the level of pay in the industry, and then I'd sort of do I used to be asked by my investment bank to go to some of the recruiting shows at some of the schools. And one of the first things that they were asking 15 years ago was, yeah, what are the technologies you guys are using, right? They're all incredibly digital nowadays. They want stuff on mobile phones. They want to be able to go into I mean, they're all, they're building their whole life now around AI, right? I mean, my daughters use AI all the time.
Mm-hmm.
And if you want to recruit them, you've got to give them the same toolkit they're used to having. And that's hard, don't get me wrong, because we're still at the very beginning of that. But we've got to be able to make them feel like they're in a technology-enabled environment, whether it's AI or something else, right? And so raise the pay and make a commitment to the people you're recruiting that you're focused on developing great technology to make their lives easier, more efficient, and more impactful.
Yeah. I think, David, that's really, really great advice because it resonates deeply with me because when I think about running a software business, sales is very important. You got to get in front of the customer, basically position your value prop, make the sale happen. But the best thing you could do for your organization is have really great customer success, make that customer insanely successful because you can grow with that customer. The retention of that customer is really valuable to the health of the organization. You don't want to churn customers, have a retention problem, and then it's insanely more expensive to get a new customer than it is to retain an existing customer. And I think a lot of the analogies hold here in insurance, which is you do all this work to win the book of business, to underwrite it, to measure the risk appropriately, and your opportunity to serve that individual or that entity really well, the business entity, whatever it might be, really well happens when they need to file a claim. And then how you treat them during that claims processing interaction matters quite a lot because they may choose to then go to another carrier because they had a really frustrating experience. So not only do you pay out the claim and potentially pay it out in a way that is maybe like it could be more optimized for the organization, but then you also lose that customer. So that lifetime value is lost from the policyholder, right? And I think the Japanese companies in general are famous for having really good service. Like they're just very service oriented. And I think that's a strong argument for investing in the claims function and not seeing it as a arm's length cost center, right? So I do wonder like how much other carriers will view it similarly to the way you do, which is underwriting and claims are two parts of the same coin. In order to do one well, the other also needs to be working in tandem. It's not like you could only do one and then offload the other to someone else.
I'll actually make an argument that claims may be in a difference maker. Everything you just said, I completely agree with. But what's interesting is a lot of other industries throw a ton of information at their big clients, right? When you want to go into a bond offering, right? 30 banks will come in and tell you all about, interest rates and duration and who the best investors in the bond are and how you can set up your economics to get, a better rating, all that stuff, right? We don't tend to be as good at giving our clients impactful information as other industries are. There's some notable exceptions in the insurance industry, but a lot of our clients, especially the mid to big size companies, they retain a lot of risk. Many of them have captives. And so they have a vested interest in making sure that exposures and liabilities are well understood because it's typically them paying for it before an insurance company comes on for the risk. And oftentimes they're sharing the experience together. And we're making a concerted effort to try and capture more of that information, whether it's before a loss, right? Risk mitigation strategies. AI is huge then, right? On the factory floor, in the driver's cab, all those areas where you can throw technology forward to clients. But you also want to tell them about what's going on with the cost of risk. How much is your insurance valuable to you? And traditionally, as carriers, we've sort of stepped back and allowed the Aons and the Marshes of the world to have those conversations with their clients. And they're important conversations, don't get me wrong. But I think we have to increasingly, because I think you're right, the lifetime value of a customer is very high, right? You want to do all you can to retain the client. Claim service is an important one, but also giving them data on how their claims experience, their risk engineering experience, how they can avoid liabilities, how they might think about coverage that they hadn't bought before. All that's going to be, I think, a bright horizon for the industry, given that we're going to start to get a lot more information and data and I hope that's part of our journey as we get better at data and AI.
Yeah, no, absolutely agree. All right, so pay claims professionals better and then introduce technology that is going to create a more modern experience. So why has the claims space lagged behind in technological innovation, and what has prevented more rapid progress there?
I think that's a hard one because there's so many different factors at play, right? There's a whole set of conversations around what carriers have done to modernize their platforms. There's a whole set of conversations around what the TPAs are doing to modernize their platforms. And frankly, there's the question of demand from customers, right? The demand for better service, for more information. In some cases, it hasn't been there, right? So the demand to get better hasn't been there. It was an interesting example in a newspaper recently where I think the story was about reinsurers demanding more insight and visibility from their cedent companies who had general liability books and were reinsuring them, more demand for how specific claims trends were changing because of the effect of social inflation. Now, if I were a carrier and I said, wow, and I'm a big buyer of reinsurance, maybe an intended consequence of improving my claim system would be I'm going to get better reinsurance support for my client. So, but then that's another impetus you have to weave into the story of leadership and being good at sort of driving change across the industry. So let me get back to your question because I'm not trying to avoid it. Till about 2 to 3 years ago, most of the technology conversations around claims were big industrial core systems, right? A claims system, right? So exceedance, guide wire, you name it, right there. And they were going to cost you $5, $10, $15 million on an installation. You would have 2 or 3 implementation partners. You'd have a giant number of people inside the organization sucked into the project. And it became a mammoth undertaking. It became a mammoth undertaking. And so there was never oxygen in the room for all the other things you could do around the edges, right? You had to make sure you were highly competent on those investments. And once you made them, you were sort of reluctant 3 years later, 5 years later, 10 years later to look back and go, maybe that decision was not the right one for the next 10 years, but we're too invested in it. We've got too much money tied up into it. We can't really rip it out, right? So there's a little bit of that inside the carrier model. There was a famous Bermuda company. It wasn't on the claim side. It was on the policy administration side. It was a company that it was public, and within the space of about 4 years, had 2 $10 million write-offs. They put in a policy administration system. 2 years later, they figured this wasn't right. They ripped it out. They took an earnings hit for $10 million, and 2 years later, they put another one in and then ripped that one out for another $10 million charge. So companies are reluctant to spend a lot of money, and that's been part of what's sucked up the oxygen in the room, right? It's this big thing I've got to modernize, and oh my God, it's taken up everything we do. And for the TPA market, there's sort of a slightly different problem, which is you sort of multiply that in spades, right? Because if you're a TPA, you have a core system that you use. And if you service 7 or 8 large carriers, you probably have to type the same claim into all 7 or 2 or 3 of those 7. So you spend a lot of time on keyboards. And what do? You've got your own system that you've built up, but you have to pay a lot of money for administration. And so you can't take that money and get rid of the administration and suddenly plow it back into new emerging technologies. So their challenge, I think, is they're overwhelmed with the administration of the business due to the nature of their business that they can't spend time to nibble around the edges or deep dive into new stuff. So I think you've got sort of different dynamics in the carrier and the TPA market, but they're headwinds. There's no doubt, right?
Yeah. I mean, it's large, clunky, hard to implement, very expensive software that fell under like the digital transformation term, which now is like become more of a dirty term. It's like this massive effort that sucks not only dollars but people, multi-year, and like sometimes it fails or it kind of misses the gap between what the expectations were and what reality were. And I think the goal is, I think, more modern technology that's coming online, maybe nimbler, faster to implement, faster to at least evaluate and see value from, and then faster to implement and integrate into the rest of the workflow. So, and we'll see kind of how that plays.
If you have the right leadership and the willingness to do it, right? I'm lucky. I work for an organization that's made a decision that we're going to really interrogate the capabilities of some of these vendors and these technologies, and where we think we can really help lift all our people up, get them to make their work easier, make them more efficient, right? We're on a big expansion phase over the next 3 years because we're relatively new, right? Our CEO says we're a 350-year-old startup. So we have we're going to continue to grow. Our growth has got to be done with the ability to use technology to help leverage the people we have currently in the office. So I'm lucky. I work for an organization that's trying to be thoughtful about it and not just blindly jump ahead, but it's not all organizations are committed to doing that.
Yeah, no, that makes a lot of sense, David. And I think that in order to think about this, like where we're headed as an industry, it feels like AI and process automation might be some of the tools to help with claims modernization. At least that's the hope. I think we have to see that through in terms of reality, but it may also help democratize expertise and improve decision making, because AI can learn from the expert, seasoned veterans on the team, capture the institutional knowledge that right now is percolating in their heads, and then make that more available to the entire team. So in many ways, it helps democratize what's available in the experts' heads to the new people that are coming online, the maybe younger individuals that are trying to solve for this. So we really interested to see sort of how this plays out. I think we're still in the kind of the early innings, using a baseball analogy there, but in terms of what the hopes are, what the aspirations are, and then where things will ultimately land.
I agree. We are in the early days, but the potentials are very exciting, right? I mean, I think we're on the cusp of tools that could really profoundly change how we think about claims, and more importantly, I think you said it great, although I'd like to think I started using that phrase a few weeks ago, but democratizing our experts, right? And helping people feel like they've got typically a really seasoned veteran inside of a firm may not feel like they have the time and energy to go and train people because they're overwhelmed, right? Because they're the person everyone goes to. Imagine if you could take something that they're thinking about and too busy to train anyone with and put it down in a training module based on a workflow that they figured out on how to solve a claim problem. That'd be so cool.
But I think, David, the other major challenge will be the technology is one problem, but then how do you introduce the technology so it actually gets adoption from the business people, right? The claims people. Because it needs to feel intuitive. It needs to be easy for them to basically supply their institutional knowledge that's in their heads in a way that is going to be then enabling for the AI to learn from, and then for that to self-learn and then propagate that knowledge. So I think the user experience is going to be a huge one. Thanks for the conversation, David. This was really helpful, setting the stage for what claims looks like today, what the big macro backdrop are. And I think you teased some of the major things that I think hopefully AI is able to help address. Now we'll see how that plays out, but it'll be really interesting for us to have a repeat conversation sometime in the future here to talk about what is starting to happen, right? Are we seeing some of the expectations turn into reality? Or what are the gaps potentially that we still need to solve for? But I think this is something that is going to be an ongoing conversation we'll need to have as we look at new technology like AI in solving some of the headwinds that you're mentioning on the claim side today.
Agreed. I hope it won't be a long period of time before we talk again about the success that some of the technology initiatives are having on the industry.
Amazing. Well, thank you, David. Really appreciate the conversation.
Enjoyed talking to you, Ankur.